Good afternoon. Visa is the talk of the town recently as the shares fell 6.5% over the last few days, coming off of news that they're being accused of monopolistic strangleholds on their debit card network. Now, it's no secret that credit card payment processors like Visa and MasterCard, Amex, Discover operate in something of an oligopoly. That means there are a few players that control the vast majority of the market, of which Visa is the largest, with something like 51% market share last time I looked. It could be a little bit more or a little bit less at this point. But suffice it to say, yes, Visa has a massive portion of market share in the space that they operate in. However, that doesn't mean that there is no competition, and this isn't new. So I'm not sure what it is they're doing differently that now all of a sudden, is making the government come after them. I think it's more so that the government's looking for things to go after more so now. And with an upcoming election, maybe trying to score some political brownie points by going after big corporations and the man and all that. But all that stuff aside, I don't really let those kind of talks really dissuade me from looking at an investment. I'll assume that there will be some kind of a settlement, maybe a little fine or something like that. But overall, in the long run, I don't think it's going to really harsh Visa shareholders. So we'll look at this from the perspective of it's just a drop in price for the same projections we otherwise would have made for Visa. So in terms of the superficial valuation of Visa, we are looking a little bit pumped, right? I mean, there's not many companies where I would happily pay 28, 29 times earnings, free cash flow, and operating cash flow, which are, at least in this instance, very closely correlated because of how capital light they are. So that makes it a little bit easier to assess them. Whereas something like Amazon is a little bit harder because of the CapEx. It's how much do you want to factor that in? Versus this, very capital light. Visa does not rely on a lot of CapEx in order to sustain and grow their business. So that sort of it sort of adds simplicity, takes out some of the X factor. It makes it just a little bit easier, I think, for the overall market to kind of value this company. And what you see when you look at a company like Visa is consistency. You see a substantial economic moat. You see something where, honestly, they're not in any kind of danger of going away anytime soon. You would have trouble almost envisioning how their moat could be narrowed in any substantial way over any short period of time. You just don't get a whole lot of surprises when it comes to Visa, and I think people do like paying a premium for that consistency and that lack of surprises. Visa's balance sheet is in decent shape. It's actually not quite as good as I thought it would be going in, considering the premium people pay for Visa stock. But I will say that they have a lot of cash, and the amount of debt they have over and above the amount of cash they keep on hand is relatively minimal. They could pay this off in one typical quarter's free cash flow if they just threw all the current cash they have on hand at debt and then just saved up for one quarter. So the debt is not actually an issue, even though $4 billion sounds like a lot of money surface level. When you take into account the scale of Visa, it's actually not. So debt isn't really a worry for me when it comes to Visa. The balance sheet does not seem to carry any substantial amount of risk. So yeah, not really a whole lot to see here with the balance sheet. So when we're talking about premium valuation businesses, one of the most important elements is growth. Now, this may not look like breakneck growth, but it is steady and consistent the last handful of quarters being in the upper single digits, like 9.5% revenue growth. Now, that might not sound all that impressive when some companies are growing, 20, 30%, but let's think here. This company has 97% gross margins. So every dollar of revenue growth, because a lot of their costs are not going up as much, it seems to be having a disproportionate level of growth hitting the bottom line. So while revenue might be growing 9%, for example, net income might go up 16% or 18% in that same period, which that's huge. And that's because of the high gross margins and because the revenue growth, they don't have to spend ever and ever more higher amounts of money, or at least not relative to their revenue, to keep achieving the higher revenue. So a disproportionate amount hits the bottom line, causing the bottom line to grow at a rate that's actually higher than the top line. So that's a very interesting phenomenon, and it definitely makes this modest, well, not modest, but moderately good revenue growth seem actually excellent when you look at how it translates to the bottom line. So that definitely, I think, affects how one should try to value Visa stock. So while dividends and buybacks aren't free money, so to speak, they are the way that a business can return capital to shareholders. If they do not have any other way to deploy this capital to drive further growth in the business, and they're already growing net income pretty well, revenue decently. So if they can't intelligently deploy this capital to drive those numbers up more, it makes sense that they would directly return it to shareholders in the form of dividends and buybacks. Buybacks are a little bit more tax efficient, though one could argue that it's not super effective to do them at a 29 or a 30 price to earnings. But then again, you factor in the future growth, perhaps the buybacks will have been the best use of capital, especially when you consider the tax efficiency. So I kind of get both sides of that equation. And hey, the dividend growth rate is 15.56%. They've been growing it for 16 years. So as time goes on, one's yield on cost should improve. So that's always nice to get that little bonus. And I think it's just one of those things where it's consistent and you don't lose a lot of sleep being invested in Visa. Now, granted, these yields are not free money. Now, something that could kind of be considered free money is today's sponsor. Of course, I am talking about none other than Moomoo and the 15 free stocks they give you if you sign up and deposit $1,000. Now, in addition to that, they give you bonus APY for the first 3 months, as well as margin rates that, last I looked, were lower than what you get on either Robinhood Gold or M1 Plus, both of which you have to pay a fee to get access to. Moomoo, that is not the case. They give you that without charging you anything. There's no monthly fee. So I encourage you to give Moomoo a try, especially if you're into trading, as they offer the most indicators I've seen on any brokerage that I've personally tried. I recently did my first options trade on Moomoo, buying calls on MPW, a favorite stock on this channel. And again, options access was simple and easy to achieve. It only took a matter of minutes. So our good friends, the analysts, generally think that an average price target of just over $300 a share in the next 12 months is reasonable and have a consensus of a buy rating on Visa as a result. Now, yeah, if you believe that the stock is actually worth 300 plus and you have an opportunity to get it at 260 or 270, it's a double-digit gain, of course, and downside risk probably somewhat minimal with Visa. Certainly, it could dip lower price-wise, but most likely it would only be temporary, and in the long run, you would get return on your investment. That being said, I don't know if I think that the $300+ price really passes the sniff test. Lately, it's been pretty sideways, if you account for the latest drop in stock price. And I think even though the news itself isn't like that critically bad, that since the valuation is perhaps a little bit stretched, the market's looking for any reason for a pullback, any reason, any excuse for a sell-off, and they're kind of taking it. That means I think that at large, the market doesn't necessarily believe in the valuation levels we've been at recently on Visa. But I'm going to try to come up with a number of what I might consider as a good entry point to add Visa. All right, so disclaimer out of the way. Yes, a DCF will always have limitations and is not the end-all be-all of valuation. There are some things you just can't plug into a calculator, okay? So that being said, it is an interesting thought exercise and is a temperature check on the sort of price range where maybe you want to actually start to consider something. It can be good for like setting like a watch list price, for example. So with Visa, I approached it from the perspective of this is a business that probably deserves a premium, probably will achieve a good amount of growth in the bottom line over the next few years, and approached it from that perspective. That's why I gave it a lower than what I usually do on discount rate. I would usually, my starting point discount rate wise would be like 10. I dropped it to 9, especially in light of the start of rate cuts from the Fed and everything. High quality business that returns a good amount of capital to shareholders probably will start to look more attractive. So probably can accept a lower discount rate for that reason. Then, of course, the growth, and this is just kind of my sense of it based on what they've done recently, what some of the analysts estimate in the near future, the next few years. We're going to plug 12.5% in there, and my general sense is that over time, it'll slow probably to the mid-single digits, sort of in line with economic development across the world, and not really increase too fast once we've achieved a certain level, okay? Because it's already a big business. It can't, I would imagine, sustain double-digit growth into infinity, right? It's got to come to a pause at some point and slow down at least. So that's where I'm thinking on that. And it comes out to 220. And this would be like a low 20s, like 22, 23 price to earnings at today's levels. And that's about where I told my co-host on Cashflow Kings Live, 8 p.m. Eastern every Saturday, by the way. 220 is about where I told him, like, I think that's my sense of where I would start to be interested in Visa or be considering it at least. And so these are the calculations that got us to that number. Now, granted, there's some arguments out there of why it could be worth more. There are probably some of you that are saying, oh, that's still too expensive. The discount rate's too low, yada, yada. The growth is too high. I understand all those perspectives, but certainly if there was a pullback to 220 from this level that it's at now, considering how high a quality of business it is and everything, it's at least worth a look at that level. You don't have to buy it just because it's on your watch list and it hits a certain price, but that could be an excuse to give it a closer examination, all right, and really figure out if it's actually deserving of a spot in your portfolio at that point. But that's just my sense of things with Visa. Let me know in the comments below what you happen to think. I would like to thank you all if you made it to the end of the video and remind you to subscribe and help me grow my audience. Trying to get to 3,000 subscribers. Make sure you're liking for the algorithm. And also, if you want to discuss stocks in real time with myself and my community, join the Discord, link in the description, for free. I will never charge you for that. After all, I learn just as much from you guys as you learn from me, and I hope that we can continue having this conversation around investing. Also, catch me every Saturday, 8 p.m. Eastern, Cashflow Kings Live, and ensure that you're following me on the X platform at Mr. Macho Mog. Link in the description there. I don't only talk investing on there, but it is a subject I am passionate about and do discuss. Take it easy, everybody. Have a wonderful day.